Are you sitting at home thinking, you know what? I know what the stock market is, I kind of know how it works, but I'm still not sure if I'm doing this right? Well, today's video is stock market investing tips for beginners. I'm going to give you my 7 favorite tips, so don't go anywhere. Hey everyone, Andrew Ferguson here from The Economist. Today's video is all about stock market investing tips for beginners. If this is your first time checking out the channel, thank you for stopping by. Everything I do here is dedicated to teaching others how to invest in stocks, real estate, and create personal wealth in your life. If you don't want to miss out on what's coming down the pipe next, hit the subscribe button below. That way you'll get the next video in your inbox and we'll keep this train of knowledge rolling. But you guys are here for the investment tips, so let's get going. Stock market investing tip number 1. Start early, start now, and reap the rewards of compounded interest. What that means is your interest that you get paid to own those stocks or the profit that you make just gets added to the pot year over year, month over month, and you look down the road, 50 years down the road, you have this huge pot that's sitting there that started very, very small, but it's because you had interest building interest on top of each other. It's like interest stacking. Let's do a quick example to really illustrate the point. Let's say investor A is going to start with a pot of $100,000 and they're going to invest over the course of 40 years. They're going to average a rate of return of 5% per year. So investor number 1 is going to save and save and save. 40 years later, they're going to end up with a nest egg of about $700,000. So $100,000 turned into $700,000 over the period of 40 years. That's a pretty good return. And all you had to do was put that initial 100 grand in the bank, let it sit there and let it grow over time, let compound interest do its thing. Investor number 2, same deal, 100K, throw it in the bank, 5% interest, but we're going to change it up and go 30 years instead of 40. So 10 years less, and what happens? Instead of having 700K, they're only going to get about 430, okay? That's a huge gap. That 10-year split is worth about $270,000, even though the interest rate's the same, even though the base amount of 100K is the same. So start early, start now, and reap the reward of compounding interest long term. Investment tip number 2, fees matter. There are lots of ways that you can invest in the stock market. You can do a professionally managed portfolio, you can do your own portfolio, you can do a mix of both and have a little bit that you manage and some that a professional does for you. But at the end of the day, you got to watch out for the amount of fees that you pay because they can really cut into your returns. And to illustrate that point, let's see what happens when there's a 1% difference in the rate of return. And in that example, we're going to assume that that 1% change is just basically the fee that you have to pay someone else to manage your money for you. So in our first example, 40 years, 100K down, 5% return, we're at $700,000 after 40 years. Same time, 40 years down the road, 100K invested to start, 4% return now, so only 1% difference. And we go from $700,000 all the way down to $480,000. That is a huge difference. And it's all because of 1%. So if you think 1%, 0.5% doesn't matter, it actually does when you take it into account over time. So do your due diligence, check out the fees today that people are going to charge you for investing. If you think they're too high, shop around or educate yourself and go manage your own portfolio and avoid the fees altogether. They'll be minimal if you do that, and you can reap the rewards of compounded interest and low fees over time to maximize your gains. Tip number 3, you need to have a goal when doing this. It's not really going to work out great if you just do this as a hobby, something to kick the tires at and just do in your spare time. You can do that, but you're probably not going to make a lot of money. So you have to have a goal of what you're working towards. Otherwise, how do you know if you're doing things well or doing them poorly? You'll never be able to kind of track your progress. It's really important to kind of have that clear picture of what you want to get out of this. Do you want to invest for the long term and use this to fund your retirement? Do you want to invest for a short term and then try to use it to pay for something else? Maybe the goal for you is to be a short term investor and just pull that equity out when you have it and use it for things like vacation, children's education, looking to invest in something else, a different kind of venture, a business, real estate, whatever it may be. But you have to have an idea of where you want to get to know if you're on the right track or not. So if you're going to do it, go all in, get your goal, write it down, keep it somewhere you can look back to and say, you know what, this is why I'm doing this is why I invest in stocks, and you can clearly define if you're on the right track or not. Tip number 4 is right along the lines of having a goal. You also need to have a strategy of what you're going to do. You can't just be going in and just deciding, you know what, today I'm going to do this, today I'm going to do that. No, you have to have a concept and an investment strategy that you're going to follow and different checklists that you're going to go through and say, you know what, these are there today, they may not be there tomorrow, so I'm going to take a look at this and maybe do this investment. The best thing about a strategy is that it's repeatable. You're going to have a defined list of metrics to look out for and a system to actually guide you through your investing. Once you have that, you're never going to lose it. You have it for life and you can go back to it and tweak it as required, but you have it, it's yours, and you can follow it to more profits in your investing career. So you need to have a strategy of what you're doing and how you're going to make things work. So we are on stock tip number 5, and it is all about having a tracking system. Whether it be a handmade journal, an Excel spreadsheet, a Google Drive, Google Sheet, whatever it may be, you need to have something where you can write in every trade that you do, monitor your account balances, and know how you're actually performing on a day-to-day, week-to-week, month-to-month level. If you don't have this, you're basically shooting blind, and there's no way of tracking anything. There's no way of actually knowing if this is actually working towards your goal or not, as we talked about in the other tips. Have a tracking system, journal all your trades. That way you can also take a look. Maybe you're mid-trade and things haven't gone the way you want them to, or you hold a stock and it's gone down a little bit more than you'd like it to. You have the ability then to look back and actually see what you bought the stock for, what you got the option for, and if it makes sense to maybe offload it and take that loss instead of just waiting and waiting and waiting, because you don't really know when you bought it, what you bought it for, and you're just kind of going off memory at that point. That doesn't work, and that's how you can lose even more money if you make the wrong decision, and then just it compounds things if you don't have things written down and recorded properly. So have your tracking system, use it religiously. That way also when it comes down to accounting and tax time, you have a documented list of everything that you've done, and there should be no discrepancy between your actual account that you use and your spreadsheet or journal at home. So you probably heard your parents, maybe your grandparents say, you know, don't put all your eggs in one basket, you have to spread out the risk a little bit. And if it worked for them back in the day, it should still work for us now, and the same thing holds true. You don't want to be too heavy in one asset category. And what I mean by that is when you're investing in stocks, there are different sectors. And for example, if you want to go really, really heavy into telecom, like your AT&T, your Bell, your Rogers in Canada, you don't want to be too heavily invested, say like 95% invested, because if that sector tanks, a large chunk of your portfolio is going to be wiped out. What you want to do is invest in all the different sectors that are out there a little bit. You might want to go heavier on ones that you're a little bit more comfortable with, or ones that you know a little bit more about. That way you're a little bit more plugged into what's going on and you can make adjustments easier and make more money. But you definitely don't want to have all your assets in one sector. That is just asking for trouble. And if again, that sector goes down, your portfolio is going down with it. So diversify, get into different sectors, hold a bunch of different companies, and there are easy ways to do that. You can use ETFs, you can use mutual funds, you can go about it whichever way you wish. You can pick individual stocks still in different sectors, but spread out the risk and you get to reap the rewards of other sectors that are doing well when some might not be doing as well. And at the end of the day, you're not too worried because risk is spread across the table. Here we go. Last tip, best tip. Cut out emotion. You need to be able to trade in an emotionless state. If you're angry, sad, intoxicated, whatever it may be, you probably shouldn't be trading because that's a good way to lose money. There's a thing called revenge trading, which happens when a trade goes through, you lose it and you don't make money on it, you actually lose money on it. And then you have this idea that I have to get back at that company or I have to get back at that stock. And you look for opportunities to do so, but you're in a revengeful state and it doesn't go well. Your mind's not clear. You have to be able to just let go. And the hardest thing to do as a trader is to just say, okay, I messed up. I'm going to be okay with losing this money. And you just take the loss and you just move on. It's so hard to do, but when you can do that and separate yourself from the trade and just become emotionless like a robot and follow your system, trading becomes much, much easier and less risky. So become emotionless, follow your system, use your journal, take these tips that I've given you today, and even as a beginner, you'll be able to see progress in your trading moving forward. In addition to these tips, I want to bring up today's question of the day, and it is, what company do you want to own shares of, or are you most excited to own shares of right now? What is that one company that you're just all in on? You have their shares, you're going to buy their shares. Let me know what it is. Would love to hear from you guys. Thank you for checking out the video. Again, if you found it useful, click on the subscribe button below. That way you'll be updated whenever a new video drops. You won't miss any content. You can also go over to the Economist blog, www.theeconomist.com. Check out the articles there. There's some great stuff. Remember, it's all about real estate, stock market investing, and creating personal wealth in your life to create the freedom that you want to live life on your terms. Thanks for checking in. I'll see you on the next one.